The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady. And, 3 weeks? Not even 3 weeks, right, guys? Yeah. I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey, happy Saturday.
Happy Saturday. Christopher Fabian.
Hello, Esther.
Has everybody got their Christmas shopping done?
Heck no,
Some of it.
Esther.
Some of it. Some.
I'll tell you, one of my friends had this really unique Christmas gift from her kids.
Yeah.
And it's something called Living Memory Videos.
Oh.
And they come in and they sit down and ask you, how did you meet your husband? What was it like with the kids? What are your best memories? Should they go through photos and everything? And the bottom line is, it's supposed to be like something when the grandkids are like 30 and they don't know what grandma and grandpa look like, or what they played the video.
That's cool.
Isn't that nice?
That's different.
It's so touching.
Yep.
It's so touching.
So it sort of captures, and they could say things, and
my best memory with grandma was
Yeah.
I mean, because I don't remember my grandmother's voice anymore.
Yeah.
It would be great. But anyway, that was something nice.
That was
I thought.
cool. Different.
So,
Very
right.
nice.
Thoughtful.
Okay, but not Christmas related.
Right.
We got like 3 weeks before the end of the year, so we're going to talk about that. And if you have any questions, whether you're getting love letters from the federal government, the state of New York, the federal government, by the way, for those of you that got the employee retention credit, they're looking at over 20,000 of them because there was so much fraud. So if you're somebody that's having trouble with the employee retention credit, you can call us and we'll help you with that too.
Yeah, and I also saw that they put a pause on employee retention credits right now, the IRS, because there's so much fraud. Yeah.
There are some people who really deserved it.
Right.
Hair salons, restaurants. But, if you're a business and you shouldn't have got it, and this place came to you and said, hey, guess what? We got $500,000 for you. It's like that prince in Africa saying, hey, send me 10,000.
Right. I just inherited money, and all you need to do is give me $10,000 so I can send it over to you.
Yeah.
Yeah, right. Okay. Anyway, I'm Esther Gulius, the Tax Lady, 8030930, 8030930, star 930 on a cell phone. And we're going to go to Tom, who's been waiting here. Hi, Tom. How can we help you, sir?
Hi, Esther. Thanks for taking my call.
Yeah.
My son will have income of about $8,000 in 2023, plus about $6,000 gain from an education savings account for money not used for tuition or college expenses. Do you think he will owe a penalty for underpayment of taxes on that?
All right. Is he single?
He's single, yeah.
How old is he?
He's 21.
Is he in college?
He's in his last year, but we have excess money in that account.
Does he have student loans?
No.
None.
Okay.
You're going to claim them, sounds
Well,
like.
Is this the fourth year of his education or fifth?
His fourth year.
Okay, so he has an education credit that would be something that you're going to get, but if you're looking at like 14,000 income, 6, 12, 14, with his standard deduction, if he owes anything, it might just be like $100, right?
Also, but is he planning on going to graduate school?
Right, there you go.
No, we asked him that question, and he says no, definitely no.
But again, you don't have to make that determination right now. He might not want to right now, but he might want to in 5 years.
Right. The reason I ask now is because his income will be a lot higher in next year and the years to come.
Well, what you can do, you're the account holder. He's the beneficiary, correct?
Right. Correct.
So you have to age 30 to use that money on him, or you can change the beneficiary because maybe by then you will have a grandchild. and you can put that money in the grandchild's, change the
Interesting.
beneficiary. So then you don't have to take it out and pay the tax on the growth and pay the penalty on the growth.
Right.
That's interesting.
I
Yeah,
mean,
didn't think about
because, life is so strange. I mean, I can't tell you how many times I've said in my life, I'm never going to do this. Never, never, never. And I do it, right? Sometimes things change, and what you think you're not going to do, you might do. And your son, like Chris says, could get married. Then you have grandkids, and you can change the beneficiary, and the money just keeps growing tax deferred. And what a blessing to a grandchild.
that. Right.
And then he doesn't have to pay the tax for
Right.
the year that he's claimed as a dependent.
Not that there would be much tax right now, but the
Right.
thing is, I think that since life is fluid, at this point you can always pay the taxes on it, right?
And you've been claiming him as a dependent for the last few years, right?
Right.
Right.
Yes, because you can claim him up to the
Right.
age of 24 as long as he's in
full-time
school
student.
full-time for at least half
this
the year.
this makes his return simple this year. He's not going to have any tax liability, and you can always claim the money. But right now, I would give him a chance to find the future Mrs. Whoever and see how life unfolds. And you do have like another 9 years before it becomes imperative.
Right. Okay.
Okay?
But one more thing, the education savings account, unfortunately, it isn't a 529 state-run plan because they passed a bill that said you could use excess money in the 529 plan and you can put it towards Roth IRAs in the future in 2024.
Right, but you still have the right to wait on
Right.
them.
Okay. But I didn't know if there was a education savings account might be the same as a 529. Apparently not.
No.
No, one's federal, one's
one's state.
529 is the state.
Oh, okay.
Okay?
Great.
All right, thanks, Tom.
Good
Thanks for
question.
calling.
Thanks.
All right,
Okay,
I'm
bye.
Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. 3 weeks left till 12/31, right? That means
Correct.
the end of the year. One of the things you want to do is if you have a flexible spending account at work and you haven't used that money that you have earmarked for whatever benefit that you are looking at, you want to make sure you use that money because if you don't use it, you will lose it.
Correct.
So as of
Correct.
12/31. And for those of you that don't have a flexible spending account, that's something you would take up with your employer and you would set it up so that they start setting aside that money, earmarking that money for next year for your special projects.
Right.
Right?
That's exactly right. Yep.
All right.
So you want to, if you
I'm
have
Esther
questions,
Gullius, the
let us
tax
know.
lady, 8030930, 8030930, star 930 on a cell phone, 716-8030930. We're going to take a short break. We'll be back on the other side, and we'll talk to you.
We are family. I got all my
Hey, to us, you are family. This is Esther Gullius, the tax lady from EG Tax. We're going to be opening our offices when? January?
About January 15th.
January 15th. The IRS will be open around the 22nd of January. So if you do have all your stuff together, we can get you in line to get everything sent to the IRS
People are calling
first.
and making appointments right now, so just call.
And that's a good idea, by the way. If you're somebody that had to wait till March or April to get in to make an appointment, make your appointment now. You don't need all your stuff to make the appointment. So let's say that we have everything but your brokerage statement. We'll do everything, put it in hold, and put it, when you get the brokerage statement, you drop it off.
correct. Yep, absolutely.
So
Just
this
get
way you
most it
kind
done.
of name your poison, so to speak, right? Okay, another thing I want to talk about. Let's talk about RMDs. What is an RMD? What do those initials stand for?
Required minimum distribution.
So what is that a bad thing? What does that mean?
So all your life, your working life, you're putting money into pensions or 401ks or IRAs. And if it's not a Roth, it's going in tax-free. And so now the IRS says once you reach the age of 73, used to be 70 and a half,
Then it went to 72.
Yep. You have to take out a small amount of whatever, or it could be a large amount. Usually the divisor is around 28, so that now you can start paying tax on all that money that you saved up tax-free throughout your whole working life.
But now here's the thing. If you are a senior, and obviously if you're 73, you're a senior,
Right.
your standard deduction is sufficiently high so that for many of those base period years when you're doing your RMD, if you have no other pension plan provided for you except for Social Security, you won't pay taxes on the RMD either.
Correct.
And if you plan it right, many of you who are well under 73 who don't pay any taxes should start withdrawing from your pension plan because your standard deduction is so high. You can whittle that down so when you do have to do your RMD, there's not that much money in there.
That's right.
Right,
Yeah.
Chris?
Yeah.
Yep. Yep.
Yeah. Because there's so many people who are like, I'm not at the age where I have to take required minimum distribution. But I think if you break it down, they still should take some money out
Right.
because they don't have to pay tax on it.
So let's say that you're 70, let's say you're 60, right? And you're retired over 59 and a half, and you start taking out, you don't have to, but let's say you start taking out 10,000 a year, or that 13 years, it's 130,000 that you get out of there.
That's right. Yep.
So, and then what do you do with that money? You put it into an investment.
Correct.
Yeah, you could even,
CD.
talk about Roths. You could convert it
Right.
to a Roth. This
Right.
way, it's still in
Right.
technically a retirement plan.
Right.
It's if your kids could inherit that tax free. So it's a win-win. You took it out tax free; they get it tax free too. So there's that, and there's also you could take your RMD and do a QCD.
That's right.
Qualified charity distribution.
Right. So that's where you can take up to 100,000 of money into an IRA and roll it into a charity, making it not taxable to you, and the charity gets the money, and it can save you on IRMA money. It can save you on Social Security taxability, and it's a great way if you're somebody that is philanthropic and you want to give to charity. This is a maybe smarter way to do it.
Right. Yep.
Right?
Yep. That's right.
Okay, let's go to Cliff. Hi, Cliff. How can we help you, sir?
Hi, how are you today?
Good, sir.
Good. I want to know how much money I can take out of my retirement paying the least amount of tax as I can.
All right. Can we ask you some questions?
Okay?
All right. Are you married or single?
Married.
And are you over the age of 65? 65 or older?
I am.
Okay. Do you have a pension plan?
I do.
And how much are you getting? You and your wife getting each month from your pension, not your Social Security, just your pension,
Gross or net?
gross.
Gross would be $14.15 a month. Boy. 7, 2, 8, 1.
You're ciphering, hey?
It looks like $15,970.
Well, let's call it 16,000. Okay.
Okay.
So besides that pension, any other source of income besides your Social Security? All right. And how much are you and your wife getting each month in Social Security gross?
I get $14.98. Again, we're talking around 16. Looks like 16.8, 16.9. So 17,000.
17,000. All right. So, and that's your only source of income, correct?
Correct.
Okay.
It has been for the last number of years. I mean, we've had other income.
Okay. So we got 8, 24. All right. So right now your Social Security is not taxable. Okay. Because you're under the $32,000 limit where any of it would be taxable. So the only thing that would be potentially taxable would be your $16,000 pension. That's your standard deduction is $30,500. So that means you have about
Let's say about 10,000.
yeah, 10,000 you can take out of your IRA or your pension plan that would also be tax free. So
Okay.
that's what you should do.
All right. Well, what about?
Or roll it over, like Tiff was
take
saying,
out-
you could roll it over to a Roth.
Okay, I'm interested. I mean, I'm going to need money the next couple of years here. I'm running out of money that I've had set aside.
You mean from
I haven't
savings
taken any
accounts?
money out of retirement yet, but there's like a 10% tax bracket, right?
No,
and then a
okay, but
12%
wait, hang on, Cliff. The 10,000 we're telling you to take out,
There'll be
you're
no
going to
tax.
pay zero taxes on it.
Right. So I definitely want to take that out.
Right.
I'm going to need about $50,000 a year for the next indefinitely.
All right,
So I'd
but
like
is that
to
including your Social
much-
Security? Is that including your Social Security?
No, $50,000 out of my retirement.
All right, so you're saying that your retirement money is moving from 16,000 to 50.
Or you need on top of your
needs.
you make about 35,000, we'll say, between your pension and your Social Security. You're going to need another 50 a year on top of
On
that.
top of that?
Correct.
Understood.
Okay. So then you're going to definitely pay taxes at about either 10 or 12%.
Right, but also then
But most of it will be at 10.
but then 85% of his Social Security is going to count as
Right.
income, so he's going to pay basically double tax. So
Right, on the Social
I would say
85%.
give us a call during the week, and we'll run the numbers for you to tell you how much that 50,000 is
I
going
mean,
to
you
cost
definitely need another 50?
Well, yeah.
Okay. All right. I
Because
mean,
that used to be your
I mean,
what you
that's
had it all in
great.
savings, and so you know.
Right.
Yeah. And
but
so
anyway,
yeah,
but
I
you
put it in
you'll
while
still
I was
you'll still
working,
be
and
in the
I've been
12%.
selling-
You'll still be in the
I've
12%
been selling my
tax bracket.
business assets and haven't taken any more out of the last several years. But at some point, and I'm thinking next year, I want to start taking about 50,000. That's why I saved it,
Yep. Yep.
so that I can take it out.
Okay, but if you don't really need to, you know, the best thing to do is come on in. We'll show
call.
you all different ways that you can look at taking this money, because most of it's going to be at the 12%, and then you will owe a little bit to New York State as well.
Okay. I
Okay.
want to get as much this year as I can. You know,
Right, so take that
I don't wanna
10
leave
out.
any in for free. So
Take the
Yep.
10 out.
Yep. Yep. Yep.
okay, but
Okay,
I can come
Cliff.
right into your office and they'll show me.
Yeah, we will. Just our phone number is 632-7886.
All right.
All right, thanks, Cliff.
Thank you.
Bye-bye.
Merry Christmas.
Merry Christmas. Okay, and then we're going to go to. Yeah, we got time. Well,
got a
oh, I
text.
got this. Hi, how can I help you?
Well, they hung
Hello?
up. They hung up. They hung up, and then another.
I thought it was
caller-
Jack. Hello, Jack.
They hung up. They
oh,
hung
Jack
up.
hung up. All right. And then we got a text over here.
It
Chris?
says, asking a question about Roth account. My financial company takes $600 a month out of my bank
There's
account.
Jack.
Do I still have to pay taxes on this at the end of the year? Thanks. Well, because it is in a Roth, you are going to pay taxes on it.
Well, in other words, it's not deductible like a traditional IRA would be, or a traditional pension. So, yes, the money that you're earning that's going into a Roth, you don't get the break now, but you don't pay taxes later.
Correct. Yes.
There might be a retirement savers credit for you if you're, you know,
If your income qualifies.
if your income qualifies.
Okay, we're going to go back to Jack. Hey, Jack, how can we help you?
Yes, I want to ask you about RMDs.
Yeah.
I called your office yesterday, and the girl gave me an answer. But I've got an amount of money at the end of February, and I put it into a money market account the 1st of March. Now, I want to know, do I have to pay tax on that?
Is it
I'm
in a
over
pension?
75.
Is it?
I'm over 75. I got a pension.
Is the money that you're talking about in a pension or IRA?
No, it's not in a pension.
Is it in
Or
an
in an
IRA?
IRA?
It's an IRA. It's a money market IRA.
Okay,
Yes.
then no, you don't pay taxes on the income.
Well, are
Not
you-
till you take it out.
That's what Mike, because he said RMDs. Is this the money you're taking out and then moving it from the IRA to a regular money market account? Or are you shifting it inside the IRA?
No, it's money that is due to the government, taxes, and I'm taking some money out. So the first 2 months, okay, I didn't take any money out for IRMD because I didn't have the money. And now I'm in the last month, the 12th month. I don't know what to do. What
Okay,
do I
all right,
report?
wait a minute. Jack, any money that is made in your IRA, until you take it out, you don't pay taxes, all right?
I
That's
understand
number
that.
one. Number two, If you're over the age of 73, which you are, then you're basing your distribution on 12/31 of what year, Chris? 22.
22. Yep.
Right? Not on 23.
I don't have anything. This money was put in.
I know, so you don't have to worry, Jack.
But
It's
when
next
I don't
year.
have to pay this year, but next year.
Next year.
so you had no money in the IRA at all
I've
prior
got
to
it.
20.
I've got a large amount in there right now. I made this account simple because I didn't want this money to mix in with my other money. It's a separate account.
How did you get the money into an IRA, Jack? Did you roll it over into an IRA? How did it get?
I'm one of the Teamsters. Let's put it that way.
All right, so you got a
That's-
distribution from the Teamsters, right?
Right.
And that's how you got that money this year.
Right. I got it
Okay,
the
so
first
that
month,
money
and
is you're going to have to settle up with Uncle Sam for your RMD next year based upon the fair market value at the end of 12/31 of 23.
Right, but
Right. So go on.
you didn't take your lump sum and put it right in the IRA. You got the check and then you put it in the IRA?
It came right straight through from
It was a
you
direct
mean-
transfer to transfer.
and they went
Okay.
right to a
Yeah,
Vanguard.
right.
Went right to Vanguard. The money
I
market
just
account.
They had
wanted
that
Yeah,
option.
I know. That's why I wanted to make sure that's what happened.
Okay,
Because-
Jack, you're in good shape until next year.
Next year.
Oh, okay. Thank you very
Thanks,
much.
Jack. Thanks for
Good.
calling.
That was wonderful that the
bye.
Teamsters
Yeah.
got that.
That's right. You do wonder how in the heck that happened, right? So, all right, I'm Esther Gullius, the tax lady. We're going to take a short break for news. We'll be back on the other side with your comments, questions, and etc.
The bills make me wanna shout. Kick your heels up and shout. Throw your hands up and shout. Throw your head back and
Well,
shout. Come
we
on,
are hoping, aren't we?
I'm making it happen.
Hoping and praying.
Hoping and praying, thinking.
Chiefs.
That would be a great Christmas gift. It would be. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, 716-8030930. We have a text, right, Chris?
It does. It says RMD, federal standard deduction is high, but what about New York State?
Well, it's not as high as the federal, obviously, but
You get to exclude 20,000.
But you see, the deal is, even though it's a standard deduction on an RMD, the first $20,000 is tax free on New York State. So up to you to 20,000 and up to your spouse 20,000. So they're going to eliminate without regard to the standard deduction. It's over and above this, up to $40,000
Right.
on a married couple.
New York State
So,
is very kind to
citizens,
retirees.
right.
Yep. Which is and
got to
to
be kind
seniors.
to somebody, right?
You do, but other states aren't. So it's nice to see
Right,
that we have
that's
that
true.
going for
All
us.
right, another thing we want to talk about, and again, give us a jingle here if you have any questions, is changing your filing status. Obviously, what you are as of December 31st is what you are the whole year. But a lot of people don't realize that they can move from a filing status, for instance, of single to head of the household if they have a qualifying relative that lives in their home. And so if you are somebody that's maintaining a home and you're single for a child, stepchild, grandchild, mother, father, and they qualify as your dependents,
Right.
then your filing status moves from being single to head of the household. And if you've missed this over the last 3 years, we can amend and get you your money back.
That's right.
And everything in tax code is based upon your filing status. So changing your filing status for the better is really a great move.
Yeah, most definitely. Yeah, there was somebody who called in the other day and they got married. He just called in and it was December. And all year long he was single and he worried that he didn't switch it to married joint. And I was like, it doesn't matter. You'll just have a little bit bigger refund.
Right.
Yep.
Okay, now here's something that a lot of people, we talk about selling losing stocks, but a lot of people don't realize that your stock losses are not just limited to 3,000 total. Your stock losses are limited to the entire amount of gain you have plus qualifying dividends plus $3,000, right? Chris?
That's right.
Yeah.
Okay. So let's say that you had $100,000 in stock gains this year and qualified dividends, right?
Yeah.
And how much could you have in losing stocks to offset that?
You could have all of it, all of your losing stocks to offset it.
That's right. So if you find out from your broker that you have gains this year of $100,000, and I hope that happens for somebody, but you have on the left-hand side some real dogs, but you think, I think they're going to come back next year, you can sell those and offset dollar for dollar that loss up to $100,000, actually up to $103,000.
Right. Right.
And then buy that losing stock back in 31 days.
Yep. The $3,000 is you're allowed a $3,000 loss per year. So you've used all of the gains,
right?
And then you've sopped it all up.
But if you don't sell that stock, then you're going to pay taxes up to 20% plus the other.
And maybe more of your Social Security would become taxable.
Right, and the state of New York
Yeah.
if you don't. So it's really important if you're looking at your portfolio and it's been pretty good and you're looking at big capital gains and you're looking at big stock gains, check with your broker and find out, do I have anything that isn't good?
That's right.
Right?
Yeah, I know certain clients call usually in December, and they'll have a consultation with their broker on the phone, and for instance, with Chris, and they'll check to see if that situation fits, right, Chris?
Yeah. I mean, you got to see what you have available to make it to your advantage.
Well, it's like anything. If you never look into it, it just doesn't happen, right?
That's right.
All right. Another thing we want to talk about is if you are somebody that I was just on an airplane a couple days ago, and a gentleman said, gee, I think I'm going to close on my rental property in the next couple weeks. And I said, well, if you wait for 4 weeks before you close, then you don't have to settle up with Uncle Sam till 2025.
Correct.
So, so if you're somebody selling depreciable assets, especially machinery, equipment, or anything other than your personal residence, if you can wait till January the 1st or later, then you defer the gain on paying the taxes for a whole year.
Yep. Which is so smart. And so he probably had pause, and he's like, oh.
Well, that's exactly what he did. He said,
Yeah.
oh. And let's face it, it doesn't take much to hold up a closing in New York State,
No.
especially around the holiday.
No. You want to go to Tom?
All
or
right,
you
we'll
wanna-
go to Tom. Hello, Tom. How can we help you, sir?
Yes. Me and my brothers and sisters recently inherited my mom's house.
Okay.
We have a written agreement amongst each other that as long as I take care of the place and pay the taxes and, maintain the place, that I can live here in this house.
Okay.
Okay. I guess it's called a life estate.
Well, no, but it's not. But go on.
Well,
Because have they passed? Has your parents passed? Are you?
Yes.
You're the heirs. Okay. Go on.
Yes. And I've always filed my income taxes as single. Would I be able to change that to head of household?
Is there anyone living home with you beside yourself?
Yes, me and my brother. He also owns part of the house too.
All right. Does your brother have any income?
Yes, he does. He's
All
on
right.
Social Security disability.
Okay. And does he use that money? He has no taxable income then, just Social Security disability. Does he put that money in the bank? Did he? What does he do with his money? Does he actually help you to maintain support for him?
Yes. He helps pay the bills in the house.
Well, had your brother taken that money and not used it towards his support, okay?
Mm-hmm.
And if he weren't on the title, which he is, then you would be able to move to head of the household. But your brother doesn't qualify as a qualifying individual because he's actually helping to support himself because he lives in a home that he partially owns and he's using his Social Security towards his support.
Okay. All right. That's what I wanted to know.
All right. Well, thank you for calling.
Good thinking.
Okay.
Good thinking
bye.
for sure. Okay. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. That was a really good thought,
there's something called a support worksheet, and so if you fill out a support worksheet, you can see.
But just FYI, let's say that in this situation, Tom's brother had, let's say he gets $10,000 in Social Security, and let's say that the total amount of his support is $8,000. If he had put that whole $10,000 in savings and didn't use it as an item of support, and he wasn't in a home that he owns because he's a part owner in it, then his brother would be the sole supporter of him, and he would then change that filing status head of the household.
That's right. And so it matters what he does with the money. What were you going to say, Chris?
And then what he asked about it being a life estate. No, the life estate would have been something his parents had set up for the house to go directly to the kids, not going to probate, where behind the scenes they were the owner once the parents pass away.
Okay, let's talk about that, Chris,
now
because that's so important. So let's say this time of year, parents are, they're thinking about planning and everything like that. The parents are the one that establish the life estate on their property that their kids then titled after a period of time, correct?
Yes.
Okay, and that would make the children get a stepped-up basis in the house so the kids wouldn't have to pay taxes on it. That's what a life estate is.
Correct.
Yeah.
Right? And unless it came through an irrevocable trust.
Right.
Because if it's in an irrevocable trust, you don't get a stepped-up basis.
Correct.
Right? They just changed that law this year.
Yep.
All right. Let's talk about, anyway, 8030930, 8030930, star 930 on a cell phone. Hold off on, I talked about the taxable until January. Get deductible items for Christmas or if you're self-employed for your business.
Yep.
So and now I just talked to a guy the other day. He said, well, during COVID, I really lost a lot of money. I lost like $60,000 a year for 2 years in a row. And this year, I think I'm going to make like $30,000. So I'd really like to have a big loss again. So how do I do that? And I said, is there anything in the business that you need? And he said, no, but I could go buy a bunch of stuff. Now, why is that bad thinking?
Because you're buying it all in the last quarter of the year. And so the IRS has wised up to that. And so when you depreciate something in the last quarter, you don't get to deduct a whole lot.
Right. But also, you're talking using the mid-quarter instead of half-year convention for depreciation. But with the 179 and all that out there, you could do it. But the thing is it a need? Or is it a want?
There you go. Well, and I don't. In this case, when I was talking to him, it wasn't a want or a need. It was he didn't want to pay taxes.
Well, then it was stupid.
So now, whenever you are doing something like that to avoid taxes, that's a no-no. For one really good reason. I mean, first of all, it's against the law. But secondly, let's say I go spend $60,000 on stuff that I don't need, so that I can save $6,000 in taxes. Does that make any sense to you to spend $60,000 in the 10% tax bracket? You only save $6,000 in taxes. So you've actually spent $54,000 to save $6,000.
Yeah, that's like when people call up and they're like, I made $80,000. Should I not work very much in December because I don't want to go into another tax bracket? Well, that doesn't make any sense because
and the tax bracket, let's say you move from 10 to 12.
Right.
2% is the only difference.
Exactly.
2%.
Yeah.
So if you could make $10,000 in December, you're talking about 2%. How much is 2% on 10,000?
It's like instead of $1,000, it's like $200.
$200, right? So I mean, before you start doing thinking, call us because we really want to help you, right?
Yeah.
All right, I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone.
To go back, but to go back, it has to be necessary. Go on, Chris.
Right.
I'm sorry.
I just want to say too, he's also shooting himself in the foot. Because if he is self-employed and he claimed a loss in his business, now he wants to claim another loss, he's not building up his Social Security.
Yeah.
Well,
So-
actually, this guy's got a W-2 for about 110.
Okay, well there you go. But
Yeah.
but you know where I'm
but
going with
yeah,
that.
absolutely, absolutely. Okay, we're going to take a short break. We'll be back on the other side.
The bills make me wanna shout, kick your heels up and shout, throw your hands up and shout, throw your head back.
I'll tell you, I was talking to somebody the other day, and that's exactly what he was said. The bills do make him want to shout. I'll tell you, you just can't keep your fingernails on. When
Yeah,
you're, some of
yeah.
these cliffhangers.
Oh,
Anyway,
it's
we're
so funny.
hoping.
One of my clients came in and they gave me this. He knew I was a Bills fan, and he gave me a damn it doll. And it's this voodoo-looking doll that has Buffalo Bills stuff on it, and when they do bad, you're supposed to
throw it on the
throw it
floor?
on the ground, hit
Smash
it, and
it.
smash it, do whatever.
Let all
a
your
good idea.
he has a little letter tied to it. Make sure when you're frustrated, you feel like screaming, you just smash this little doll.
Okay, going back to things to think about, I wanted to talk about contributions because people don't seem to understand that part of your itemized deductions, which would be your standard deduction or your itemized deductions, whichever is greater, charitable giving is part of the itemized deduction. So the other day I had somebody that called and said that she and her new husband had just gotten married and they didn't need this they had two cars between them and a third car.
Right.
And she wanted to give the third car away to her church. And I said, what a lovely thing that is. And she said, so first thing I said is, how much is the car? How much did it cost you? It cost her $40-some thousand. How much do you think it's worth now? 20. And I said, so you want to give a $20,000 vehicle to the church? And regardless of the fact that you'd have to do the fair market value thing if they auction it off, but I said to her, now, do you have large medical bills? No. Do you have any property taxes? You have about $4,000. Mortgage? No. So what you have is like a $20,000 car to charity and $4,000 in property taxes. She says, yes. How much will I save in taxes?
Was she
So-
married?
Yeah. So
Okay.
what will she save in taxes?
It won't help her at all.
Not at all.
But maybe
so
on the state.
So I said, you're better off selling the car.
Correct.
Oh, but then I'll have to pay taxes. Will she have to pay taxes if she sells the car?
No,
No.
It's
No,
a
because
personal
it's
asset
under
for a loss.
right, because it wasn't used for business and she sold it at a loss.
Correct.
Now that doesn't mean I'm not for charities, because I am.
Yeah.
But it's not as easy as you might think.
But she
and
could've-
I wouldn't want you to labor under a delusion. Yeah, Chris.
She could have sold the car for $20,000,
Thought about that.
kept $10,000, and gave $10,000 to the church, and they wouldn't have the headache of auctioning off, waiting for it to sell.
That's
they had
true.
the cash,
Right,
Yep.
but
and it's still the same effect on the tax return. Nothing.
that's true. Nothing. All right. I'm going to go to Dan. Hey, and Mr. Dan, how can we help you, sir?
Hi, Esther. How you doing today?
I'm good.
Hey, listen, I just caught the tail end of someone who called in discussing cap gains and cap losses, the offsetting one with the other. And I didn't quite understand that. So you said there's a $103,000 limit.
No. I just gave an example. That's all, because I wanted to do the really ridiculous that doesn't usually happen to have people listen.
So there was a gain of 103.
If you had stock gains of 100,000,
Right.
then you can offset all of those gains plus 3 or 103 on your Schedule D, and you'd pay no taxes on those capital gains. But you don't know until you look at your brokerage statement how much you have made in capital gains and qualified dividends to do that offset, and you only have till the end of the year to do it.
And so what you offset it with is losers, and so you
Right.
might not have any losers.
Right.
I understand, yeah. Now, what I'm confused about, too, is that what's the $3,000 limit with ordinary income?
Well,
Does that
that's
make any-
okay. So in this example of somebody that had 100,000 in stock sales,
Right.
capital gains, and they had stocks losses, they did 103,000 in stock losses. So they're going to offset the 100 by the 100 dollar for dollar, so they have no capital gains, but they're also entitled to carry forward an additional 3,000 to offset other income.
Got it.
Got
you
it?
explained that very clearly. Yeah, and it's a good thing if you have losses, obviously.
Right. I mean, and the thing is, there are people that are carrying, like, I think Disney's having a tough time, and people love Disney. If you're somebody that's lost money on Disney stock, but you don't really want to get rid of it because you're hoping that the happiest place on earth is going to come back next year and going to be okay, you could sell it, take the loss, and then buy back the stock in 31 days.
That wash rule, right?
Right.
The 31 days?
Right.
Hey, great explanation. If I understood it, then most people should. Thank you
All
very
right.
much.
Thanks, Dan. Thanks for calling.
Bye-bye.
All right. I'm Esther Gilius, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. That's why I wanted to use that far out example.
Right.
So that, because a lot of times people think they know and they don't really know.
Correct. So that makes it more concrete when you put it in an example.
All right. And the other thing is, New York State has a bed tax. For those of you that have private pay patients, that you're ponying up $14,000-$15,000
Full
a month
nursing home care.
For nursing home care. The state of New York is charging how much is it, Chris?
The credit is 6% of what your daily rate
But they
is.
charge you
They
more.
charge 6.75 now to 8%.
But the credit
New
is
York
based
State-
on 6%.
Correct.
Yes.
Right? So if you gave $200,000 to a nursing home, you have a refund coming for that bed tax of $12,000 from New York State.
Correct.
And if you don't fill out the form, and the form number, Tiff?
258. Is it 258, Chris?
258 or 248?
I think it's 258.
258.
It's the NY 258, and if it's a simple little one-page form, but if you don't fill it out, then they're not going to send you your $12,000.
You mean they don't let you know?
They don't. They shouldn't even be assessing it, really,
No.
if you think about it.
No.
So that's something you want to take a look at as well. All right, now we got Kurt. Hello, Kurt. How can we help you, sir?
Hey, how you doing, Esther?
I cannot
love the
complain.
show. You guys do a great job. Really appreciate it.
Thank you.
I was talking at golf today. I was doing the virtual golf at Buffalo Golf and Social, and I was talking with one of the younger guys, and I was wondering because he was telling me what he's paying for child care nowadays. But the problem with child care, what is it, $300 a day or whatever? If you got two
Crazy.
kids in there, is there anything you can do from a tax standpoint for child care today?
Just
Child care, because the standard deduction is what, 12 and 24, I guess, right, or whatever. So
12
is there-
single, 24 married, about.
right.
about right, approximately.
But
Yeah.
you can
Anything
use
a
the
younger guy can do for child care today from a tax standpoint.
the flexible spending account is probably the best that would be over and above that. Would you guys agree with that?
Yep.
Yeah,
yep.
but there is a credit that's not in itemized deduction. It's a standalone credit. It's a child independent care credit. It's done on a form 2441. And then New York State also has a refundable credit for child care. So you were talking about itemizing. This is a credit that stands
no,
alone.
I think he
was talking about the standard
but
deduction.
What I'm trying to say is there anything you do because he's taking the standard deduction, obviously, right?
Right. But
is there
he's going to
anything
take
that
he's going to
is there
take
anything else he can do, or just he's
Well,
just
that's where
it,
he
I
would do
guess,
the
right?
flexible spending. Explain, Chris Tiff, explain the flexible spending
yeah.
and how
For-
that would save him. That would give him the biggest bang for the buck.
Yeah, for 2023, it's too late to do the FSA. He needs to get in touch with his employer now and do it for 2024. It's where you take money out of every paycheck and you put it in an FSA account. So it's a pre-tax benefit. So if he makes $50,000 a year, he puts $5,000 for the year. His W-2 is only going to say $45,000, and that's all he gets taxed for income and Social Security and Medicare. So it could save him over 20-something%,
Right.
including New York State. If he
Right.
does,
Is that something? I mean, obviously, if he's at a bigger, is that something his company's going to do? Is it to their benefit, or I
Well,
don't
they
know.
just
I mean,
do it because it's in the law. But this is something he has to approach them with. But if he's with a larger employer and they allow him to do that, he'll save the FICA plus the credit, and it'll save him federal and state, and then he gets a little bigger bang for the buck.
But for 2023, let's face it, he didn't do the flex
Right.
spending, so he would do a credit. It's a 2441. It's a child independent care credit. And then on New York State, there's also a refundable credit for child independent care.
Right.
Right. Hey, thanks, guys. I really appreciate it. Great
All right.
show. Love the show.
Good
Thank
luck
you very
golfing.
much.
All right, thank you.
That's right. A couple of years ago, when
Oh, it was huge.
they had given away the kitchen
Oh,
sink
my
with
God,
the
the
daycare.
COVID.
But,
Oh, yeah.
But
And we thought
anymore.
they were going to keep it that way.
Right. All right. Looking at interest income, there's a lot of people that have gotten some pretty good, and I hope you have put it in high interest bearing accounts. And so this year, many of you are going to be using a Schedule B, and you haven't been using that for years. And so bear in mind that if you have U.S. savings bonds or Treasury bills, that's only taxable on the federal, not on New York State.
Correct.
So that's a subtraction on New York State. Now, if I had, this is another thing for consideration, if you had $10,000 in interest or $10,000 in qualified dividends, which is better from a tax standpoint?
Dividends, because you could pay at a lower interest rate because you could pay at the 0% interest
That's
rate.
That's exactly right. So if you're somebody that has a tolerance and wants to be in the market, if you're going to make $10,000 in interest versus $10,000 in qualified dividends, you're better off doing dividends because you may not pay anything on dividends, but the maximum you would pay would be 20%.
Yeah, and then don't forget on your dividends, you also might have a 199A credit, which is for a business credit, and so don't forget to take advantage of that. And also, there might be a foreign tax credit on your dividend, which is an 1116, so don't forget to also privy yourself of that as well.
All right, and then looking at the higher interest rates, people are paying a lot higher interest rates on mortgage.
They sure are.
And so for the first time in a long time, especially if you're a single person, you may really take a look at itemizing because you got your property taxes and your mortgage interest.
Right. And if it's, mortgages are going up, that means more interest, but it also means for most people too is the PMI. If that's still there, I can't remember if that's still there for 2024.
It wasn't there for 2022.
On New York State it is, though.
Right.
Education credits. First 4 years of continuing education, you would qualify for the American Opportunity Tax Credit, which can save you like almost $2,500 a year plus the state of New York. If you go beyond that, then it's lifetime learning, which is a 20% credit up to $10,000. Energy credits, they are giving you 30% of what you do for your Energy Star, windows, doors, insulation, things of that nature. And there's a higher, which limited to $1,200. And there's a higher credit also for energy conservation if you're doing like biomass stoves and things of that nature. And then don't forget New York. I was just teaching somebody taxes the other day, and he said, wow, New York State is a harder return than the federal. And I said, you think? Hello? Anyway, I'm Esther Gilius, the tax lady from EG Tax. If you're getting ready for the end of the year, you can go to our website. We got some pretty good ideas on there. And you can always call us at 632-7886. Until next weekend, I'm Esther Gilius, the tax lady, with Chris and Tiffany Fabian. Thanks for listening.